Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, April 4th, 2025. S&P 500 currently sitting at 5192. I'm David Zarling. I'm here with mystery reader Ian McMillan. Plenty to cover this week. But first, I think it's great that you could be there for your son and read for the class.
Yeah, it was really cool. Kate got to do it earlier this year. I got to do it today. So that's always fun to get to surprise the kiddos.
Core value number 5, life outside the office. It's awesome. What'd you guys read about?
Planet Earth.
Okay. Excellent. Hey, sometimes those things are, I shouldn't say sometimes, almost all the time, more important than what's going on in markets, but plenty to cover this week for people listening. Obviously, the narrative backdrop is quote unquote Liberation Day and tariffs, but we also have a market response. And it's easy to put two and two together and say those things are related, but quite a move this week.
Yeah, at least over the last 2 days. Last Friday, we've gotten a little bit of a bounce, I guess. Still kind of down near the lows. First few days this week were fine, but never made it back above any important levels. Right. Whether it was the 200-day or various anchored VWAPs, the July 2024 highs. And then when, we fell apart.
Yeah, I mean, it adds credence to the phrase, nothing good happens below a 200-day moving average. And here we sit, it wasn't that long ago that we were testing the underside of a 200-day moving average back at late March. And have since fallen since then about 10, 11% using something like the S&P 500. And when you look at that data set, when you look at the prior 200 days of information, which is what defines the 200-day moving average, the backside data that's going to be, we're below the level of that backside data. So the data that's going to start dropping off actually will cause this 200-day average to flatten out pretty doggone quick. Here we sit, S&P 500 currently at the levels we saw in early August 2024 after the brief July correction of last year. But it's the old adage, up the escalator, down the elevator.
Certainly feels like that.
And just like that, quite a few months of gains wiped out.
About 10 months?
Yep.
Going back to last May, and we had the August 5th Japanese yen debacle. But yeah, from March through, what was that, mid-February, 20% run. Pretty strong run, right? We had the election in there, and those gains were given back for a while. I would say that was kind of the first red flag. We're still kind of above a 200-day in there. I guess they were kind of lining up. The Tuesday close, so election night close before the gap. Yeah, gave that all back. That's kind of another one of those big, not a technical level, but a behavioral level for sure, because we all remember that market reaction after the election. So now you sit there and say, wow, we gave all that back. Yeah, I think that definitely said something, and we're seeing some follow through from that.
Yeah, for sure. Well, and those who practice the artful science of technical analysis, it is interesting to watch price move up into levels that the base from 2022 through 2023 created, reach that target, reverse, clear a 200-day moving average. And then the pennant we were talking about just a week or two ago, because you have your initial move from all-time highs.
Yep.
Back in late February, you have a counter move into the 200-day from the underside. And now we've already reached target of that particular move. And so the process then becomes, right, because our clients are familiar, we're little to zero exposure to equities, copious amounts of cash and T-bills, and that's great. But from a process standpoint, Ian, markets are a future discounting mechanism. They're dictated by supply and demand. Obviously, supply has control. What are some levels that you're looking at where you would say, hey, it would be interesting if demand returned here to, because the first thing that has to happen is price just has to stop going down. Yeah. We haven't had that yet. Are there levels that you're looking at where you say, hey, that's an area of interest? That's a place where buyers have showed up in the past. Are they, we want to pay attention to them. Is there anything you're looking at in that regard?
I mean, I'd just kind of say where we're at this morning. The 5,100 is where we were on August 5th. So we'll see.
Yeah, 5,100 is the August 24 low. It's near the April 24 high. From a volume profile analysis, we've had volume in here in the past. So it'd be interesting to see if we get some buyers here. But dare I say, if we're losing 5,100 or 4,000, that a number we talked about for what felt like a year is back on the table, 4,800.
That would be tough. That would be tough from a technical perspective. Definitely it would be a bummer to give that all back. But markets are bummers sometimes.
They are. That's why buy and hope is not necessarily a great process. Right now, we're in a situation of what we would describe a falling knife. So prices.
Yeah, we talk about the S&P being down what? I don't know what it's down, 15%, 16%. But, how many stocks are down? Even before this week, down over 20%.
Right. And now we're starting to see correlations go to 1. We talked before hopping on here that Europe was holding up just fine before even yesterday. And here we are today, and they're selling those too. And so this is where you're starting to see
selling gold.
Yep. Things go
gold is fine.
Directionally the same way. And that's when you see correlations go to 1. Where we are in that move, I don't want to sit here and say, oh, that means we're close to some type of bottom. I have no idea. But 5,100 is a good line in the sand. And there will be big bounces in here. You got a VIX at 43.
Well, even if we bottom here, there's nothing, based on our process, not doing anything.
Right.
And we won't know it's a bottom till...
Afterward.
Yeah, till maybe we get to all-time highs, I guess.
Mm-hmm.
So, it's the same with, it's the same with Monday, Tuesday, Wednesday, sitting in cash or watching the market move higher while you're uninvolved. I don't really feel any emotional attachment to that. And the same on the last 2 days. There's no, what's the best way to put this? It's just another at bat.
Right.
And we could bottom here and the S&P stays flat and then we're back in. And there's so many different scenarios of how things could play out and whether, is it good for, is 200-day moving average the best? Sometimes it is, sometimes it's not. But glad to be out for clients. I will say that.
Correct.
Clients definitely, and they're allowed to be emotional. They're absolutely allowed to care. We care. We're not bat flipping though.
Yeah, it's interesting that two things can be true at once. You're unemotional about it, but that doesn't mean you don't care.
Yeah.
You have a process, you stick to the process. You have your rules, you stick to the rules. But that, most people like a market that goes up, right? That's an environment with a tailwind. That's an environment where you can grow accounts. And there's a time to grow capital and there's a time to protect it. And we're in that protection mode. Those familiar listening to this would recall our episode back in late February that laid out the bearish thesis. We quickly wiped through some of those items, clearing the January low, clearing below the January 1st price, clearing below election day, clearing below a 200-day. And here we are, lower 15% since that episode. So was that episode prescient? Sure. Broken clock is right twice a day, but it's about analyzing the weight of evidence as a whole. And at that time, things were fine until you saw credit spreads start to increase pretty rapidly. And when there's credit stress or liquidity stress, something's up. And now you have junk bonds, kind of signaling days before yesterday that there might be more stress in the system than originally thought. You saw the yen, you saw treasuries, you saw gold all moving higher together. That typically is risk off. And here we're seeing the fruits of that. And then you highlighted last week high beta stocks versus low vol stocks. And now we're all the way back at the 22 lows in that relationship. I mean, that's where the last bear market ended, was summer, fall of 2022. And we're back at that level quickly for high beta stocks versus low vol.
Absolutely agree. A lot of dead canaries coming into this week.
Mm-hmm.
Sometimes it means more trouble on the horizon, like now. Sometimes, like November 2023, doesn't mean anything, or it's short-lived. But like we've said many times on this podcast, clients will know we've stated it, almost monthly for years, that we don't know what's going to happen. It's all about the process. And it's okay. It's okay to go below the 200-day and get back in. I think most clients are cool with that. But what we're not going to do is just assume, well, November 2023 was kind of a fake out, so I think this one could be a fake out. We are not going to do that.
Yeah. Why try to catch a falling knife? You never do that to your child, a knife falling and, hey, quick, grab it. No, just let it hit the floor. So we're in price discovery mode. We've got a falling knife in price. We need to find demand. We need to find where the buyers are willing to buy, see that establish itself first before any, substantial involvement can even begin. And so that's just the current market environment. People love predictions. Where is this market going? As Ian alluded to before, there's lots of different ways that this could play out. I mean, it's great to finally see a put call ratio over 1. It's great to see VIX in the 40s. Typically your 1 to 5 year returns, once you see that, are pretty good. But the idea that I can sit here honestly on this episode and say, oh, the bottom is in, there's no way to know that at this point.
There's absolutely no way. I mean, this is really day one, to your point, of correlations increasing.
Mm-hmm.
Your Europes, your golds had kind of hung in there. Now we've reached, oh my gosh, just get me out, or feels like we're starting to get there. But that also happened in October 2008.
Right.
And then we didn't bottom for another 5 months. So
yeah, and it's really interesting because, leading into this moment, you saw AAII survey information showing record bearishness. So tip your hat for their sentiment. You didn't see the positioning. And then let me get your opinion on this, Ian. We have JP Morgan yesterday saying retail investors bought 4.7 billion in stock yesterday, which is the largest level over the past decade. I don't know. When everybody's dip buying, is that really when it ends?
Usually not. I mean, if I had to guess, I would say no.
Right. And it won't be a straight line. I mean, this goes back to, I think, a few episodes ago, we talked about missing the best days in the market. That's the old mantra of why you should buy and hold, is because you're going to miss the best days in the market, which completely excludes the data study process of the best days happen next to the worst days. So it is increasingly likely that in the weeks to come, your best days of 2025 are going to start happening.
Mm-hmm.
But that's also happening next to the worst days in 2025. So there will be.
I think next week could be a great week.
Right.
I'm sure. VIX at 40, that works both ways.
Right.
You can have big green days with a elevated VIX.
Mm-hmm.
Whether that, is a bottom, the bottom. I don't know.
Yeah. And we're in rarefied air. I mean, when you look at, Bespoke put out some good information that today is just the 4th time that the S&P has gapped down over 1% for 3 days in a row.
Wow.
Last time we saw that was COVID, March 9th, 2020, and the great financial crisis, September and December of 2008. So pretty historic, but that's what markets do. They constantly are recording historic moments, but it is notable, and also thankful to have clients in cash, to be in protection mode. And there will be a day this market firms up. There will be a day when it turns back around. Maybe that day is today. What are the odds of that? I think slim, but who knows? I mean, I'm not here to tell the market what to do, because everybody's got an opinion, right? Everybody thinks the market's wrong. That's the exact opposite framework you should have as an investor. You should always assume that the market is right.
Yes.
And make sure that you're positioned accordingly and understand when you're wrong. And so here we sit in price discovery mode, trying to figure out where either the selling stops or the buying begins. Don't know that if that's here, 5,100, 4,800. There's a scenario where we bounce for the rest of the month back into the 200-day and then roll back over.
There's so many. I mean, and that's what is tough when these gets itself in these stuck between a rock and a hard place. You could have a great rally over the next week, 2-3 weeks. You rally 6-7%, 8%, and not fix anything.
I mean, to your point, just getting back up into a 200-day will take about a 10 to 11% move. Could happen, but that might not fix anything. So definitely damage done across a lot of different instruments, Europe included. You know, we had seen a lot of strength in Europe, some places in Asia, and those kind of gave way this week.
They did. China had been holding up pretty well. I mean, did have a failed breakout, I guess, a few weeks ago. Relatively, I guess, still holding up okay, but yeah, some damage done there for sure. Really, no one. Who is there anything you would say that it's actually held up well, other than long-term treasuries?
Well,
I would say Bitcoin.
That's what I was just about to say.
Okay.
Bitcoin versus S&P is really something to behold, because we're back above that relative neckline near 15, 16 in a ratio, in talking in ratios. So the fact that Bitcoin held up like this is, you always want to pay attention in broad red tape. So when you're seeing this broad selling, the things that are holding up, example of that would be S&P is currently down about 4.5% on the day, but here Bitcoin's down minus 0.14. Maybe there's something there. Maybe there, when it's kind of like pushing that beach ball underneath the water analogy that we've used before. When that pressure releases, so when this downside pressure of selling, broadly speaking, releases, this scenario piques your interest on the possibilities for Bitcoin coming out of that. Because Bitcoin's not up on an absolute basis today, but the fact that it's holding up so well on this red tape, because I mean, we're close to a 90% downside day today. So 90% of issuance is down. That
wow.
Bitcoin's not doing that. Makes you wonder, when the beach ball is released, if Bitcoin's going to pop pretty aggressively out of here.
Totally agree.
Yeah. And what's also interesting is oil losing the 65 handle that had been setting up really nicely. And we've sliced through that pretty aggressively. And they've taken the more risk on areas of energy with it. Your oil services, things like that. They've really hammered them. And so, yeah, you might be seeing lower prices at the pump here in the near future. Does that mean great things for the market? It might not. Good for your gas tank, maybe bad for your account if you're exposed to it.
Yeah. Never the best sign to see that. To your point, I mean, it is cool to pay less at the pump. And we've been fine. I mean, crude going lower is fine. It's been in a range for a few years, like you said. We'll see. I'd put copper in that same category.
Yeah, copper
had been setting up really nice,
and now just,
I don't know. Not the best move.
Yeah, I mean, lost the all-time highs. I mean, it had just had all-time highs back in March using copper futures and quickly sold that off. And again, you're seeing credit stress, whether you're looking at triple C credit spreads, whether you're looking at something like junk bonds versus intermediate bonds, there is credit stress out there. How about the dollar?
Yes. The dollar. Hitting continues, right? I mean, I guess dollar's been in a downtrend since January. We kind of, got the bounce off of 106, which is, we were above this range, right? That 106, 107 was kind of the top end of this range. And then early March broke that. Yeah. Back to the low end.
Well, I think it's interesting noting how quickly things can change. Financials had been a relative leader, and here we have XLF down almost 9% on the week.
Yeah.
I mean, when you start to see the leaders taken out, I think some of the bigger developments too this week were when you look at the relationship of XLK technology versus S&P, breaking important levels that had been in existence for quite a bit of time, going back to June of 23, we broke that neckline. You look at semiconductors using SMH versus S&P, breaking the neckline that has existed since the beginning of 24. And then when you talk about semiconductors broadly using XSD versus the S&P, major breakdown. And that's breaking down from a range that's been in place since 2020. So 5 years. So 5 years of potential relative distribution of broad semiconductors is something to pay attention to. Now, is this some type of flush that we're experiencing? We've talked about in the past few episodes wanting to see a flush. Is that flush? And we move higher from here going forward? No idea. And we'll happily participate again if that's the case. If this is a flush and we move back higher and we're back above a 200-day and something like S&P, would happily participate. Now's not the time. What else are you looking at, Ian? What else piques your interest or has you sit up taking notice?
Oh, no, you mentioned home builders earlier. Home builders are green today. Bitcoin, it's really retail. Not terrible today. Definitely a little bit of intriguing stuff, but really, I mean, oh gosh, it's pretty bad across the board.
Right.
It is pretty bad. I know you mentioned earlier they kind of finally got to energy, which had held up well. China, silver.
Silver had set up really well, and now they took it behind the woodshed. And again, that goes back to correlations are getting closer to 1 across the board. Anything to raise cash is being done. And so you have to pay attention to these different dynamics that sometimes there's no safe place.
Each chart on its own merit. Is that what you're saying?
Yep. Each chart on its own merit. And there's just a lot of broad selling today.
Well, to your point, I mean, I know that you had been involved for a while in communication services.
Right.
Which had been holding up great on a relative level, but the absolute chart down, right? So just because it looks better than all the rest doesn't mean you got to keep it. It can still be ugly, taking on its own in a silo. The chart's still ugly. You don't need to own the prettiest ugly chart.
I like that. It's true. Sometimes cash is king. And not all market environments are the same. And that's why I have to highlight the supporter of this podcast, the Adaptive Select ETF, listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. So there you have a product which we're aware and can publicly speak that it moved to T-bills and cash below a S&P 500 200-day. Cash is king. Cash is king sometimes. Again, it goes back to there's times to grow capital and there's times to protect. And the current environment is to protect, regardless of the narrative. I get that there's a ton of narratives out there and immediate response might be how bad tariffs are. Who knows? 18 months from now, we could be ripping higher to highs we've never seen before because of this tariff process. I have no idea.
Yeah. Don't be surprised to see the market start pricing things in, positive things before the media does.
Mm-hmm. Yeah. Wet streets don't cause rain. Price moves first, then the narrative hits. And always have to keep an open mind on resolutions and outcomes. That goes back to the sports analogy of you just can't assume pre-snap what's going to happen on that play. You just want to be aware of the options. And one of those options for the S&P 500 is that we bottom somewhere in here, or we find demand near 5,100, maybe 4,800. Time will tell. I mean, all we can do is be Bayesian statisticians, taking in the most recent data and weighing it the most heavily. And here we have very strong evidence of selling in this market. No other way to say it. And until that storm subsides, we'll just park the ship in harbor and wait it out. Anything else you want to add, Ian, worth highlighting for our listeners before we ask them to share and give us great rankings?
No, I don't think that we're at the buy the dip place yet. I just don't. I don't know what I think this goes back to my comment earlier about just being from a technical perspective, just being non-emotional about it. I don't know. We'll see. I am mentally as prepared that we gap up 3% on Monday as I am that this continues lower.
Yes.
And neither of them matter. I'm not doing anything on Monday. So it doesn't affect me.
Yeah, you could have a face ripper of a move that doesn't fix anything. And yes, if you're in cash, that might feel terrible. But these things have to play out. You have to see a sustainable bottom established to prove that buyers have control of this market. And that's just not the case. Sellers have control of this market for sure. And we're at a falling knife. And, if you're buying stocks today, it's 100% guess.
It is.
And some might say, well, every time it's a guess. Yeah, but why?
There's better guesses than others.
Yes. Why step in front of a bus here? Let's just hang out on the sidewalk for a little bit, let the bus clear, and then we can get involved. So remains a risk-off market. We're seeing some liquidity stress. Sellers have control. And until that changes, we'll be on the sidelines. Our clients are familiar with that. We hope that everyone appreciates the information that we put out. Share it with your friends. Give us a high rating on your platform of choice. That's a compliment to us, and we appreciate it. Otherwise, we'll be back next week.
Have a great weekend, everyone.